Hi everyone, good morning. So today we'll be starting with enterprise and equity value questions. These are basic 15 questions which we will be learning in detail. So without wasting any time further, let's get started with the reading. So question number one. This is an important question, and it's also been it's quite often asked in interviews. So the difference between enterprise value and equity value, and also why do we look at both of these? So basically, enterprise value represents the value of the company that is attributable to all investors. So enterprise value includes all investors. This means the equity component is also in there, and the debt component is also in there. So all investors, debt holders, and equity holders, the both are covered in the enterprise value, while in equity value only represent the portion available to shareholders. So equity, as the name suggests, it's only about the shareholders of the company, the equity investors who actually have an ownership in the company. You look at both because equity value is the number the public at large sees, while enterprise value represents the true value. Um, so let's do a detailed analysis for this. Enterprise value is actually also known as the market cap of a company. So enterprise value, how do we do a detailed, how do we calculate enterprise value? This is also an important aspect. So enterprise value is basically equity value and debt along with preferred. Okay, let me just show you this thing. So if we were to calculate the enterprise value, let's talk about enterprise value first. So enterprise value is basically the equity value of the company, the debt portion, the preferred stock portion, minorities interest, and we subtract the cash and cash equivalent portion out of it. And if we look at the, let me just tell you with this as an example. So if a company has 500 million of debt and if a company has 50 million in debt and 10 million in cash, so enterprise value, we will add the debt and we will subtract the cash. We will use the cash to pay out our debt. So if you were to buy a company, so you will look at the enterprise value of the company. What will you do? You will first acquire all the possible equity from the market and from the other investors. That way you get an ownership. But once you get the ownership, the debt portion, you will actually also have to take care of the debt portion and the preferred stock portion. So along with equity value, you will actually have to spend the debt amount also because once you are the owner of the company, the debt also comes as a cherry on the cake. And the preferred stock and the minority interest, these also you actually have to look into all. You will be responsible for those. And you can pay off these items using the cash and cash equivalent on the balance sheet. So the total value of company's operations available to all investors, just not shareholders, is called equity value. And it includes debt and subtracts cash because debt investors also have a claim on the company's assets. So if you are a debt investor, so you will have a claim on the company's and cash equivalents. And cash is not a part of core business activities. So it could be used to pay the debt. The formula we have discussed, the formula for equity value we have discussed, and also the example. And about now talk about the equity value of a company. So equity value is basically the value of the equity of the company. Equity value in simple terms is basically just the value of shareholders' ownership in the company. And if you were to ask to calculate how do we calculate the equity value, basically equity value is the number of share price, the current share price, and the number of outstanding shares. So that's how we calculate the value of the equity. The balance sheet numbers, I'm not talking about the balance sheet numbers. If you were to calculate, this is a common mistake. You do not calculate the value of equity from the balance sheet, but from the current market share price, and the number of shares outstanding. Just remember this thing. This is an important point. Do not use balance sheet numbers. The balance sheet numbers represent the book value of equity, not the actual value of the equity. And uh, when why do we look at both of these? It's because to tell different stories. So the concept is, let's discuss about the concept also. So the concept here is, who does it belongs to? Pardon me. Okay. So the concept here is who it does it belongs to, used for, and what it tells you. So equity value, it belongs to the shareholders and used for public market valuation. And what it tells you, how much the market thinks the company's equity is worth. So equity value is the concept of equity value, and what it tells you is how much the market, how much the market thinks the company's equity is worth. So if you were to buy a company's stocks on any stock exchange, so you will calculate the equity value. And enterprise value is who does it is what it tells you is what the business as a whole is worth regardless of capital structure. And it's used for valuing the entire business operations. And who does it belongs to? All investors. Like previously we have discussed it, all investors, debt and equity and others. So preferred stock is there, minority interest is there. So enterprise value belongs to all investors, and it's used for valuing the entire business operations. And what does it tell you is what the business as a whole is worth regardless of capital structure. The easiest way to remember these the equity value and the uh, enterprise value is, just remember that the equity value is what shareholders own because of the name equity used here. So equity gives us a indication that it belongs to the owner. It's about ownership, and ownership is also only with the shareholders. The liabilities with the shareholders, and enterprise value is what the business is truly worth to all investors. We look at both because they give us different perspective, one from market's point of view and other from the company's total enterprise total enterprise value. All right. I hope this is clear. Let's move to question number two. So question number two is, when looking at an acquisition of a company, do you pay more attention to enterprise value or equity value? So think about this question for a moment. When looking at an acquisition of a company, when you are acquiring some company, what would you pay attention to, enterprise value or equity value? And previously we have discussed this thing that looking, if we were to buy a company, we will look at the enterprise value, which will include the equity value also. So enterprise value, because that's how much an acquirer really pays. That include the often mandatory debt repayments. So the concept here to understand is that, let me just show you. Give me a moment. So the concept which you need to understand here is that the equity value, this is the value of shareholders' equity. We have discussed it previously because basically the company's equity and how much it is worth to the shareholders. And it represents the value of company's share. And the formula is the number of the current share price, and we multiply it with the share outstanding. So this much is the company's equity, the value of the equity in the market. Book value could be anything, but book value could be $1. But when we look at the equity value, so if the stock is being traded at $10, so $10 into X number of shares, so that would be the equity value. So we do not even though the numbers are reported, the book value of the number, book value of a per share is actually reported on the balance sheet. We do not use those numbers. There is a difference between the book value and the market value of the share. Just remember this thing. Don't get confused in between those things. The enterprise value is the total value of the business. So total value of the business, it includes debt, and but it excludes cash and cash equivalent, because cash is not considered as a core business. I mean, cash generated is not cash in the balance sheet is not considered as a core business activity generated from core business activity. That's why we can subtract the cash to pay, or that's why we can use the cash to pay our debt. And um, if you let's look at an example. The example is let's say that you are buying a company. So equity value is 100 millions, debt is 50 millions, cash is 10 millions. So enterprise value, once you have acquired the company, so equity value you will calculate using this formula: current share price and the shares outstanding. Debt value, it's given, and the cash is given also. So enterprise value will be calculated. We will add these two, equity and debt, 150, and we will subtract 10. So enterprise value will be 140. So even though you pay 100 million to the shareholders, you are effectively taking on 50 million in debt also and getting 10 million in cash. So when you acquire a company, you also look how much cash does it have. So it would really help us to pay back the debt portion, and actually cash helps us once you acquired a company. So all those debt and other components, you will actually have to take care of those. There is minority share also, and there are preferred shares also, which we add in this calculation. Preferred shares, and we also add minority interest. I hope this makes sense. So equity value, previously also discussed that equity value is the value to shareholders. Equity value is the value to shareholders, and enterprise value is the value of business as a whole, to value to the whole investors. All right, so let's move to question number three. Even though there is no explanation in that, it's really important to understand the concepts, the key concepts between enterprise value and equity value, and the book value of a share and the market value of a share. Let's move to question number three. Uh, so the question we have discussed this previously also. What is the formula for enterprise value? Because these questions are related to enterprise value, and these are the basic questions. So enterprise and equity value questions. So they are asking all those questions, and all these questions are around the concept of enterprise value and equity value only. So enterprise value is calculated using equity value. We have discussed why and how do we calculate the equity value: the number of shares, market at market price, and so the current market price and the number of shares. We multiply it and we get the equity value. The book value part we can get from the uh, balance sheet. The debt portion, the debt portion, we actually have to get to this debt portion, we actually have to calculate it using the long term and the short term debt. So short term debt, if those are current liabilities, so the current liabilities, as the name suggests, is these are short term debts. But when you are buying a company, so you will be more focused on the long term debts, and you can subtract the short term debts. You can pay the short term debts using the cash and cash equivalent if they are not useful, or of use and not useful to company's structure, uh, or I mean whatsoever you are using. You are, I mean, you, if you're acquiring a company, it's up to you what you will use the company for. Either you are dissolving the company, breaking it down, and selling it, or selling all the components by pieces. Preferred stock, if you, the basic definition of the preferred stock, if you know the preferred stock definition is preferred stock, the preference is given to those who actually have the preferred stocks. So whenever there is any distribution, the first distribute whenever there's a dividend distribution, the first dividends distribution actually, all those dividends go to the preferred stock. And there is a slight difference in the structure of common equity and preferred equity, because so at times there are voting rights also. I mean, there are no voting rights. At times they have extra rights. They have a preference, and that's why it's important uh, to take care of these preferred stock first using the cash and cash equivalent. So that's why the cash is subtracted and everything else is added back. So to get a complete value of the company, you actually have to be aware about this formula: equity value plus debt plus preferred stock plus non-controlling interest, and you subtract cash. So non-controlling interest was formerly known as minority interest, and we know this. So non-controlling minority interest less than 50% in a company, then you actually have to report it out in your income statement. You actually have to create a comprehensive income uh, also for this. So it adds in your income statement, but not in your balance sheet, because you do not have that much ownership, minority interest. So you represent these numbers in your income statement also. Um, I mean, there is no better way to explain it. Let me just try to explain it in a easier way. So I have this table which actually represents it. It actually explains the components. These are equity, debt, preferred stock, share, non-controlling interest, minority interest, and cash, and the meaning of these components and why it's included or excluded. So market capitalization is current share price into share outstanding. We have discussed it previously also. Debt, both short term and long term. So this is debt net. This debt is netted. So long term we subtract the short term. Preferred stock, hybrid of debt and equity. We will discuss about the mezzanine debt financing, the options, and other kind of stocks which have a dilution impact on the company. So these actually are important. And we have not covered that part because we are in the starting of these questions only. So as of now, I don't think we have we have covered 100 questions. And this series actually have more than 700 questions. So uh, we will cover that later on. So preferred stock is hybrid of debt and equity. And by definition, preferred stock have a fixed claim on company. Preferred because there is a preference given, like debt holders, so they are included in that. And non-controlling interest is the value of subsidiary not fully owned by the parent. So 100 so if it's 50 if it's not 50%, so you could consider it as, minority. But if it's 51%, it will be a majority. So you can you do not have to then report it out as a minority interest. You can just club those numbers in your in your income, net income. But if you have 49 less than 50%, then you will report those numbers as minority interest. So what why is included or excluded? If you read about this, is the parent's financial into 100% of the subsidiary result, but only part of equity. So we add back the minority interest for consistency. So you have less than 49% uh, ownership on those companies, then you will report it as a minority interest. And cash, the cash reduces the purchase price because it's not part of operations, and cash keeps on accumulating. I mean, a generation can be done by a lot of things. Uh, in a company, the changes in working capital and adjustment for the non-cash items. So cash is generated using those things also. And we can use the cash, the extra cash, to pay all these above, so that we can have a benefit in the equity value as an investor, from an investor's point of view perspective. Okay, I hope this was clear, and we have discussed about these things. In three questions, we have only discussed about equity value and enterprise value only. So let's move to question number four. So why do we need to add non-controlling interest to enterprise value? And why is that? Is whenever a company owns 50% of another company, it's required to report the financial performance of the other company as a part of their own performance. So if it owns more than 50%, then it will be a part of own performance. But if doesn't own it, or if it owns less than 50%, that they do not represent it as a part of it, as a part of their own performance. So they report it as a part of minority interest or non-controlling interest. So even though it does not own 100%, it reports 100% of the majority owned subsidiaries financial performance. So what does that mean is, it does not own 100%, it reports 100% of the majority owned subsidiaries financial performance, in keeping with Apple to Apple theme. So why do you, the question is, why do we need to add back non-controlling interest? And this happens because of when a parent company owns more than 50% of another company, the accounting rules of GAAP and IFRS require the parent company to consolidate that subsidiary's financial statements. So if you are owning X, there is a company X and there is a company Y. The parent company is X, so the parent company X will actually have to consolidate that subsidiary's financial statements along with their also. So this means that parent company's income statement include 100% of subsidiary revenue and operating income. And the parent's balance sheet include 100% of subsidiaries assets and liabilities. So assets and liabilities of the subsidiary also, they will report in their own balance sheet. And in the parent company income statement, 100% of subsidiaries revenue and operating income will be reported. So, however, the parent does not actually own 100% of the subsidiary. Maybe it owns 80%, and the remaining 20% belongs to the outsider shareholders. That 20% ownership by others is called non-controlling interest. So that's the basic definition of non-controlling interest. And how does it fits in enterprise value? Is enterprise value is meant to represent the total value of the entire business and all the company's operating assets, regardless of who owns them, both debt and equity holders. So when we calculate enterprise value, we start with equity value, market cap, the market cap representing only the portion owned by the parent's shareholders, and we adjust it to get to a value that reflect everyone's claim on the company's operations. And why do we need to add it back? If you ask in detail, why do we need to add it back? Since parents' financial statements include 100% of the subsidiaries result. So parents' financial include 100% of the subsidiaries result. The enterprise value we use to compare those financials must also reflect 100% of subsidiaries value. Uh, and in simple terms, if suppose a parent company owns 180% of a subsidiary, let me show you with an example first. Let's do an example here also. So it will be easier to uh, understand this thing. So let's assume that parent company owns 80% of the subsidiary, and subsidiary, the EBITDA I'm assuming at 100 million. So parents consolidated full, so the parent company will consolidate full 100 million in its income statement. And I am assuming the parent market capital is equal to 800 million. So its equity value is 800 million. And equity value, I hope by now you are able to calculate equity value, which is current market share into the total number of shares in the market. And then the non-controlling interest, we are assuming 20% owned by others and is valued at 200 million. So this portion, the 200 million, which was the non-controlling interest, will also be paid off the by those who will be acquiring the company. And during merger and acquisition, this is very common. So net debt, these are the numbers. So enterprise value would be 800 because it's market capital structure. And so the market cap of the company, equity value, and we will add back the debt 100 million, and we will also add back the non-controlling interest component. So here, uh, 8 plus 2 plus 1 will be 11, so 1100, and we will subtract the cash and cash equivalent from this. Here in this structure we have not used the preferred stock component. So using this, the enterprise value of the company will be 1100 millions. It will reflect 100% of operations that produce 100 million of EBITDA. The non-controlling interest, if you look at this part only, so it will give you a better picture where non-controlling interest, how they are calculating it. So they are calculating the ownership which is not owned by them. The 20% is owned by others and it's being valued at 200 million. So non-control of these numbers are for subsidiaries. So since you're acquiring a business, you will actually have to pay off those investors also who actually have ownership in subsidiaries of the parent company. So this is why the non-controlling interest component is important, and it's how it's calculated and how it should be looked at. So I understand that it's difficult, and in depth there is a whole lot about these concepts in journal, but in journal you should know that you should have a basic understanding of these things. So it's good to be uh, I mean the finance the concepts of finance, it's good to brush them up regularly. So let's move to question number 5. Okay, the question number 5 asks you, it's a new question. It's different from equity and enterprise value questions, something new, where the question is being when the question is asking, calculate how do we calculate the fully diluted shares. So what fully diluted share is and how do we calculate those numbers? So basic shares, you might have heard of basic shares. So we take the basic shares and we add the dilutive effect of stock options and any other dilutive securities such as warrants, convertible debt, and convert preferred stocks. So dilution actually increases the number of shares. If you remember the formula for earnings per share, it's net income. We subtract the preference stocks and we divide the divided by the total number of shares outstanding. But if the total number of share outstanding were to increase, so it will reduce our earnings per share. And if our earnings per share is being reduced, so there will be a dilution impact. And the dilution is created by stock options such as warrants. So warrants is a whole new concept, and warrant, convertible debt, and convertible preference stocks are, I mean, it's a different universe, and they are very deep, and you need a very deep understanding of finances to understand these things. The di- the terms and conditions which they come with, the indentures. Um, so as of now, just understand what how the dilution of the share is calculated, and we will discuss these things when we will do an example later. Uh, and just to give you a brief is so the stock options are granted to employees. So if you talk about effect of stock options, the stock options are actually granted to employees. ESOPs you might have heard of, and warrants are actually a right to buy shares, often given to investors. And convertible debt are those bonds which can be converted to shares. And convertible preferred stocks are those shares which can be converted to common stocks. So all these actually increase the number of shares outstanding, which would increase which will actually dilute the ownership of percentage of the existing shareholders. That's why we calculate fully diluted shares to understand the maximum potential share count. So the maximum potential share count is used calculated by looking at the dilution impact. Uh, okay, let's do an example. Let's do an example, and I think that it would be uh, more clear if you do an example. So uh, here is the example. So let's say a company has 100 million basic shares and 10 million options exercisable at a price of $10, and current share price is $20. So in here, it comes in concept of in the money or out of the money. And if you are doing, in the initial stage, if you are calculating the dilution impact, so you should also be aware of the in the money and out of the money concept also. So I can exercise a share, I can buy a share for $10. And there is an option given to me to buy a share for $10. However, the current market price is $20. So this means that I can buy something worth $20 for $10 only. I have been given an option, and option is actually given to investors at the initial stage. If a company like for startups, so when they are raising funds, they actually have a complex structure to raise money. So they sell some equity. Also give options to investors. They give preference shares and preferred convertible shares, convertible debt, and preferred convertible stocks also. So let's get back to the question. 10 million options, exercise price is 10, and the current share price is $20. So if it was either way around, so let's assume that $20 you can buy it for $20, and the current share price is $10. So you can buy something for $20. However, in the market, it's selling at $10. You will only exercise the option when, so it doesn't make no sense, because why would you buy something for $20 when you can buy it from the market at $10? So here comes the concept of in the money and out of the money. In the money means that you are benefiting from executing this option, and out of the money means like this case where there is no benefit of buying it. It doesn't make no sense to an investor. So I hope this was clear. In the money and out of the money. An option will only be exercised when it's in the money. Out of the money, you will let it lapse. So 100 million basic shares are there. 10 million options are there, which are exercised at the price of 10, and current share price is 20. So cash from options will be $100 million. So 100, I have 10 million options. And if I multiply this 10 million with $10, so I will have $100 million. I will have to pay $100 million to get $10 million. However, the market value of these 100 million, 110 million shares options is 200 million. So I'm benefiting by 100 million. So share repurchases are 100 million worth, and we will divide it by 20 million. The dilution impact works this way. So 5 million shares will be, there will be a share repurchase, 5 million new shares repurchased. And the net new shares will be 10 million minus 5 million. So 5 net new million shares will be repurchased. So this means the dilution, the denominator, the share count will increase by 5 million. Step one, step two, step three. So understand this thing. If you have bought shares worth 100 million, so what the company will do is they will not put this 100 million in their balance sheet. So in turn, the company will do, because you have bought 100 million, 10 million shares. So the in turn, the company, this money will, you will pay to the company. The company will do in return is they will buy back shares worth 20 million, 100 million at the current market price. So 5 million shares they will buy back, because you have the shares, new shares pumped in the market are 10 million, but the net new shares will be 5 million only. So just go step by step. This is confusing at times if you're not regularly practicing this thing. So when you do questions, you get or in real life when you do these things, so you get confused. And if you Google it, or to use any platform like ChatGPT, Perplexity, they everywhere they give different explanations. But the basics, if you are weak on the basics, you will not be able to use those numbers. In theory and in practice, these are used differently. So step one, step two, step three, just understand this thing, the concept. The money an investor will pay to the company will not keep that money. The company will in return buy back their shares from the market. And if you look at the company's 10Ks or 10Qs, you will find a column where the company repurchases stocks every month. And every company does that. I hope this was clear. And so let's move to next question. Just give me a moment. Let me just clear it out. So let's move to question number 6. Let's move to question number 6. So here is a practical example. Let's say a company has 100 shares outstanding at a price of $10 each. It also has 10 options outstanding at an exercise price of $5 each. So what is the fully diluted equity value? So we have discussed it previously, and let's first read the explanation. Uh, so the basic equity value is $1,000 because 1,000 shares and $10 each, and it also has 10 options. Exercisable at a price of $5. So it does make sense because you can buy something for $5 which is being sold at market for $10. So it is in the money. So, okay, so they also have given in the money concept here. First, you note that the options are in the money. Their exercise price is less than the current share price. When these two options are exercised, there will be 10 new shares created. So 10 new shares will be created. How? Uh, they will buy $10 or 10 options for 5. So the investor will have to pay $50. So the investor will pay $50 to the company. So 1,000, the company will have $50 extra. And that $50 they will use to buy 5 shares. So here 10 new shares are created, and here the company will buy back. So netted effect will only have 5 new shares. Uh, they have calculated, okay, I have calculated it straight away. So 5 new shares, and the fully diluted equity value will be 1050. Just go step by step. You first start with basic equity value, then you add back the option. Then what will happen when the option is exercised? Then the treasury stock method, where you buy back the shares. That's treasury. And okay, previously when we were discussing about the buyback of the shares, that's treasury stock method. So don't get confused when they say when they ask about treasury stock method. So and then you compute the fully diluted shares, and you compute the fully diluted equity value. If the share price remains $10, so fully diluted equity value will be there will be 105 new shares, and now the equity value will be as per if the $10 the share price stays $10, so the equity value will be 1050. So new equity value will be, we have discussed this thing, equity value we use by the number of shares. Now there are 105 shares, and the current price is $10. Earlier it was only $100. And don't get confused that we have this 50. Where does this 50 comes from? Because if you look at here, the share price value was 10. Here the share price value was 10, and there were only 100 shares. The investor paid $50, so it should be, don't think that it should be 1050. And we have used the $150, and this $50, where does it come from? So because the equity value, the number of shares increase, and we are assuming that the share price is $10 only. So 105 into 10 is 1050 now. This is the tricky part. After dilution, the equity value also changes. Just remember this thing. Okay, I hope this was clear and pretty much, however, I think pretty much we have covered everything in this question. Um, okay, okay, let's move to question number seven. All right. So the question number seven is saying, let's say a company has 100 shares outstanding at a price of $10. It also has options outstanding at an exercise price of $15 each. What is the fully diluted equity value? And here comes the concept which we studied, which we learned about earlier in the money and out of the money. So if the exercise price is $15 and the share price is $10, so why would we buy something for $15, which we can get at a price of $10 from the market? So this makes no sense, and we will not execute the options. So in this case, the option exercise price is above the current market price, so we have no dilution impact. So the structure of a company, when a company has a complex structure, so we also look into the securities which are dilutive in nature. This was clear, I think. I hope this is clear. In the money and out of the money, previous six questions, we have discussed everything around. We have built the foundation for everything which we can use now, all the knowledge. So this is out of the money, and this has no dilutive impact unless until this share price value increases and goes to 15 or 16, above 15. So then it will have a dilutive impact on the shares. So let's move to question number eight. So why do you subtract cash and the formula for enterprise value? Is that always accurate? The official reason is cash is subtracted because it's considered a non-operating asset, and because equity value implicitly accounts for it. The way I think about is, in acquisition, the buyer would get the cash of the seller. So it effectively pays less for the company based on how large its cash balance is. Remaining enterprise value tells us how much you'd really have to pay to acquire another company. It's not always accurate because technically you should be subtracting only excess cash, the amount of cash a company has above the minimum cash it requires to operate. Uh, so if we break down it carefully, so the company currently has, I mean, the end what the enterprise value is. So enterprise value is equity value plus debt plus preferred stock plus minority interest, and we subtract cash and cash equivalent. And why do we subtract cash and cash equivalent is, so cash is considered as a non-operating asset, and it does not directly contribute to company's core businesses. Uh, and equity value already includes cash. So equity value already includes cash because the company's market cap reflect all the assets, including cash. So if you want to isolate the value operations only, you remove the cash from calculations. And second reason here, if we talk about this intuitive reason, this is based on intuitive or acquisition logic. If you buy a company, if you're buying a company, you pay for its equity, but then gain control of its cash. So if you are buying a company, you also gain control of its cash. So effectively, net cost to acquire the company will be lower. It will reduce if you use the cash amount of the company. That's why it's beneficial to subtract the cash amount. Uh, it's the money you get back in the deal. And why is this? Why it's not always accurate is because companies need some minimum amount of cash to run their daily operations, to pay employees, to cover short-term expenses. Only the excess cash amount we can subtract the amount, and it's very difficult to understand. It's very difficult to calculate how much exactly the money. I mean, uh, during this enterprise value in detailed version, we do that in practice. That's like previously I have told you, in practice what we do and in theory what we do, they are different things. So cash and cash, previously we have learned the enterprise value formula. We subtract cash and cash equivalent simply, but it's not black and white. I mean, there is a lot of gray area also here. So we do need some cash to run our daily operations and to pay, I mean, employees and cover short-term expenses and all. So excess cash we only remove, and I mean, excess cash should only be subtracted when calculating enterprise value. In practice, analysts often subtract total cash because it's simpler, and the difference usually isn't huge unless the company has large and inefficient cash balance. Okay, so I hope this was clear, and we have talked in detail about the enterprise formula now. So, and we have also uh, understood, and we have covered something new and something very logical in practical application. Why do we subtract cash and why it's not always accurate? The formula, uh, I mean, the practical and the theoretical concepts, there is a difference in that. All right, so without wasting any time further, let's move to question number 9. So it's always accurate to add debt to equity value when calculating enterprise value. So the question is, it's always accurate to add debt to equity value. Equity value, we are adding debt when calculating enterprise value. Equity value and debt, it doesn't calculate the enterprise value. There are other components also. In most cases, yes, because the term of debt agreement usually says that debt must be refinanced in an acquisition, and in most cases, a buyer will pay off the seller's debt. So it is accurate to say that any debt adds to the purchase. However, there could always be exceptions where the buyer does not pay off the debt. These are rare, and I have personally never seen it. But once again, never say never applies. So the basic formula of enterprise value is equity value plus debt plus preferred stock and minority interest, which are also considered as a kind of debt when we subtract cash and cash equivalent. So why we normally add debt? The question, I mean, if you think about it, so when a company actually acquires another company, the purchase price includes both the value paid to the seller's equity, the value paid for the seller's equity also, the value of the seller's debt also, which the buyer usually has to repay or refinance. So And that's because the buyer is taking over the entire business, including the debt obligations also. So debt obligations will also be sold out to the buyer. So the total cost to acquire the business is equity value plus debt minus other cashes. Matlab, I mean, we subtract the excess of cash. However, adding debt to equity gives you the total value of the business to all investors. So debt plus equity will give you total value of the business to all investors. That is enterprise value. And why it might not be always accurate is there can be exceptions in certain deals. Sometimes buyer may choose not to repay the seller's debt. There could be exception that buyer doesn't choose to pay the seller's debt, or that buyer the debt might remain outstanding and simply transfer to a new owner. So there is an exception. So we add back, but there is a gray area here. Or the seller's debt might have unusual terms that allow it to stay in place. So maybe, I mean, there are always exceptions. Uh, these are some rare, I mean, these are rare situations, but they show that adding debt is not always 100% accurate because it depends on the specific transaction terms. So usually true, you add that to equity value when calculating enterprise value because buyers almost always pay off or assume the debt, but not always. In rare cases the buyer may not repay the debt, so adding it might overstate the true enterprise value. So one more time we have covered a question which was a little gray in nature. Uh, so in finance, there is not all. I mean, it's not this simple that it's correct or not. It could be both at times, and there are exceptions. So let's move to question number 10, and these are tricky questions now, which are demanding us to uh, focus and think logically. So this question is asking about negative enterprise value. Could there be negative enterprise value? I mean, enterprise value is calculated using market cap, total debt, and cash equivalent. We subtract those things. Minority interest we add, and uh, preferred stock we add. But for the sake of simplicity, I'm not considering those things. Uh, Simply, we take the equity value, the market capitalization, market cap, we add back debt, and we subtract cash and cash equivalent. So could it be negative? So enterprise value. So what does that mean? If you were to buy a company, so could you could a company be paying you back to buy it? So if you go to buy a good, I mean, let's say in sunglasses. So is there a possibility that someone is paying you to take those sunglasses? Similarly, enterprise value could set enterprise value be negative. So those companies which have extremely large balances, uh, because we subtract cash, and those companies which have large balance, if you do that, so formula wise, yes, it means the companies have extremely large balance or extremely low market cap. Companies on the brink of bankruptcy, and financial institutions is a bank that have large cash balance, but enterprise value is not even used for commercial banks in the first place. So this doesn't matter much. This actually happens in the cases of banks because banks actually have a large cash balance, and but it's not very easy to acquire a bank. There are a lot of government rules and regulations. Um, and yes, enterprise value could be negative. Not, it's not that somebody actually is paying you to take over a company, but there are circumstances where the company has a large cash balance. And if you remember the formula was market cap, Market cap is number of shares into the current market price of the share. We add back debt and we subtract cash. So the subtraction, if we are subtracting cash, and the cash, there is a large cash balance in the company. So this could generate a negative enterprise value. So you need to think before you speak in an interview. And this was a tricky question. And for that, you actually have to run all the scenarios in your brain first and then answer. So use companies at a brink of bankruptcy. So when a company is about to go bankrupt, this means their market cap is tiny. So everyone is selling their shares, and that because everyone is selling their shares, the share prices go down, and this will cause the market cap, the market cap will be less. First case is this. And institutions like bank actually naturally hold a huge cash balances. And for a bank, enterprise value is not very useful measure anyway. So when you are valuing a bank, you do not calculate enterprise value of a bank because their balance sheets are structured differently. And a bank's balance sheet is structured on the basis of liquidity. This is new information for you guys. So and what does a negative enterprise value means is the company's cash on hand is more than the market thinks the company is worth, even after accounting for its debt. And if you bought the company for its market cap, you theoretically get more cash than you paid, which is unusual and often a warning sign also. So uh, in summary and in simple terms, yes, a company can have a negative enterprise value. It usually depends on either the company is worth almost nothing in the stock market, or the company has very large cash reserves, like some banks. So I hope this clears it out, and I will see you in the next video. And thank you for attending this video.